market risks. What are they? You also know that. But we go specifically to detail on this type of risk because we are learning financial risk and management. What is the chapter outcome? At the end of this chapter, you must be able to explain, understand the concept of market risk. What are the types of market risks? And how do you measure market risks? And how do you manage them? Okay, so any market risk. Now the first one is concept of market risk. Now, once again, please do not forget to sign your attendance at the future. Line attendance itu. So first in the morning, we already signed in the afternoon again. Please be remembered to sign your attendance at the future. Now, market risk. Okay, what is market risk? Market risk, the risk of losses due to movements in the financial market prices or volatilities. These are the simple explanations about what is market risk. It is the risk of losses. It is the risk of losses. Okay, losses di mana? Losses in a bank ataupun losses of the investor. Okay, risk of losses, amount of money that you lose. Okay, a bank lost an amount of money. The investor lost an amount of money from its portfolio investment, for example. From its portfolio investment. Losses, okay, in a bank or in investor's portfolio, in a bank's portfolio, in an investor portfolio. Due to apa? Due to movements in the financial market prices, due to movement in the financial market prices or volatility. Okay, in other words, due to changes ini. Okay, changes due to okay, changes in what? In market prices or volatility. Okay, so the risk of changes in the market value of an instrument or portfolio of financial instruments connected with unexpected changes in market conditions, including stock prices, interest rate, exchange rate, and volatility of these variables. Volatility of these variables maksudnya the fluctuations of that variables, fluctuations in prices, fluctuations in interest rate, itu maksudnya. Okay? So kenapa dia fluctuate? Dia fluctuate, the fluctuations in value itu, the fluctuations in value ini, changes in the market value ini disebabkan oleh economic changes in the economic, changes in the political, ataupun due to market events. Okay? So the fluctuate in value itu is based on economic, political, market events, alright, yang mempengaruhi ini, changes di sini semua ini. Okay? So it covers risk of currency, bond and stock position, as well as other financial asset and liabilities traded by a bank. Okay, so it affects the changes itu, it affects the currency, it affects risk on currency, and bonds because of the changes in the interest rate. Currency tadi because of the exchange rate, volatility of the exchange rate. The fluctuation, the devaluations of exchange rates itu dia mempengaruhi your currencies. Okay, dan juga mempengaruhi The volatility of the interest rate mempengaruhi your bonds. The fluctuations in the stock mempengaruhi your stocks. Okay, and also of course the other financial asset lah macam derivatives. Okay, derivatives which is futures options, all of this. Okay, so market risks are generally only identified as the risk inherent, okay, in the trading portfolio. Right, so market risks, they are generally only identified as the risk inherent in the trading portfolio. Risk inherent maksudnya risk dalam kita punya trading portfolio itu, okay, yang dipengaruhi oleh financial instrument, pengaruhi oleh risk daripada financial instrument tadi. Okay. Now, market risk is the uncertainty resulting from apa? Changes in market prices. Market risk is the uncertainty of potential losses. Okay, resulting from, due to changes in market prices. Right, so in other words, when the price moves unfavorably, the value of the instrument, value of the financial instrument macam tadi, bond, stock, kan? Ataupun portfolio, it can decrease. The value will decrease because of the prices move unfavorably. So market risk is the uncertainty of potential losses due to changes in market prices. So if the market prices moves unfavorably, value of that financial instrument earlier, bond, stock ataupun portfolio, it can decrease. Okay. So you can see here that affected by other risks such as interest rate risk and foreign exchange risk. Okay, so market risk ini maksudnya di sini dia influenced by different ataupun specific risk, including, inilah yang pertama itu adalah interest rate. Okay, so market risk ini the influence or affected by other risks. So market risk ini the market prices ni lah. So they are affected by other risks such as interest rate risk and foreign exchange risk. So kalau interest rate ini, you tahu lah kan, risk of loss when the interest rate rise ataupun fall unexpectedly. Kalau interest rate to rise or fall unexpectedly, it depends lah if you are the issuer ataupun you are the lender. If you are seeing yourself as the borrower or the issuing company or the issuer. So if you are seeing yourself as the issuer, borrower, when the interest rate to rise, okay, so this could lead to a potential loss for you lah, because you have to pay higher interest expense. But if you see yourself as the lender, so higher interest rate too could be an advantage for you, right? But if the interest rate to fall, it could be a drawbacks ataupun disadvantage for a lender. So interest rate ini dia interest rate risk ini maksudnya ini adalah risk of loss when the interest rate to rise or fall unexpectedly. foreign exchange risk ini, I want you to write down. Please write down notes. Okay, jangan dengar sejak macam dengar radio. Dulu-dulu kan dengar radio, mau dengar berita dia dengar sejak. Tapi ada orang rajin, dia tulis berita apa hari ini. Dia tulis by just listening. Okay, listening. Kalau dulu-dulu dia buat begitu. Listen. Tiada TV, dengarlah radio. Okay, so tulis. Foreign exchange risk maksudnya apa? Risk of loss, ini. Risk of loss from changes in currency. Currency exchange. Okay, currency exchange rate. Risk of loss due to changes in currency exchange rates. Okay. And then can be, what does it say? Can be measured over periods as short as 1 day. It can be measured. So market risk ini it can be measured as short as 1 day. Right? As short as 1 day. Market risk can be measured over periods as short as 1 day. Okay, so this normally referred to the it is normally referred to the daily changes on the market prices. Daily changes on the market prices. Daily changes on the market prices. Okay, now usually measured in terms of dollar exposure, yalah, berapa ringgit losses, dollar exposure amount or as a relative amount against some benchmark. Okay, so the absolute ataupun usually measured in terms of dollar exposure amount ataupun relative amount against some benchmark. Okay. Kalau measured in terms of dollar exposure ni, dollar exposure tu maksudnya contoh how much money you have lost based on that price changes. Kalau market price moves unfavorably, so how much your portfolio lose? How much will your portfolio lose? 1 million, 2 million? So itu maksudnya it can be measured in terms of dollar exposure. If the market price moves unfavorably, so how much will be the effect? How much will be the portfolio? How much will be the losses on the portfolio, for example? Kalau relative amount against some benchmark ini maksudnya this one is compared against benchmark, against index. Okay, against index. So contoh your portfolio risk is your portfolio risk is 5% higher than KLCI index risk contoh. Your portfolio risk is 5% higher risk than KLCI index. Then KLCI index risk contoh. Your portfolio risk is 5%, diguna. Okay. Diguna perbandingan. 5% higher risk than KLCI index. KLCI index risk. So dia compare. Okay. Compare against benchmark KLCI. In this case, KLCI. Right? So there are types of risk here. Interest rate, like I mentioned, market risk kan, interest rate, exchange, volatility, commodity, equity. Let's look at one by one. Okay. So the first one is interest rate risk. It is the risk that arises from changes in the market interest rate, which eventually affect the earnings of financial institution. Okay. So yang terkesan adalah if the bondholder, right? Bondholder ataupun Selain bonds, loans, you have to pay higher interest on loan. Okay, so you know that there is a inverse relationship between interest rate and price of the bond. So ini adalah risk of losses due to changes in the interest rate, which will affect the earning of the financial institution ataupun earning of the portfolio. Second, exchange rate risk that arises from change in price of one currency against another. So it occurs when there is a fluctuation in foreign exchange rate, which eventually affect the receivable and payable. So katakan kalau you import barang daripada US ataupun China, you import barang daripada US lah. Because now is 1 ringgit equal to, let's say, $4 atau 4.50. $4 lah dulu. So kalau when there is a fluctuation in foreign exchange, let's say from 4 ringgit to 4.50, of course it will affect how much payment you need to pay in order to just how much payment in order to convert it into RM. So duit keluar pun sangat banyak lah sebab duit keluar pun sangat banyak. So kalau untuk kita beli $1 barang tu, kita keluarkan 4 ringgit setengah contoh duit untuk bayar. So kalau lagi tinggi nilai foreign exchange itu, lagi menyebabkan lagi banyak kita kena bayar. Alright. Dan kalau kita dan ini juga kalau kita ekspor barang tu pun sama juga. Bila kita ekspor barang, we will earn less in ringgit lah. We will earn less in ringgit. Okay. Itu yang terjadi apabila devaluations of ringgit Malaysia. We earn less ringgit if we export our goods to US contoh. Okay. So third one, equity risk. This is the risk that arises when the market value of a position is sensitive to equity market performance. So this risk of loss is due to changes in stock market prices, where the market value of the portfolio, market value of the portfolio ini, they are very sensitive to the performance of the stock market. Okay, value of the portfolio is very sensitive to the performance of the stock market. Ini yang kita boleh evaluate by beta. Market change by 10%, your portfolio change by, let's say, 20%. Market baru change by 10%, you change 20% sudah. Okay, so change by 20%. Maksudnya kalau if the market declines by 10%, your portfolio performance itu dia jatuh 20%. Very sensitive to the stock market performance. Okay, maksudnya your stock is very vulnerable. The portfolio performance of your stock is very vulnerable to the changes in the market. Tapi kita ada juga yang known as defensive stock. We invest in defensive stock. Walaupun market change by 10%, we only change by, the portfolio performance change by 8% only. So yang 8% tu known as the defensive stock. You punya performance tidak akan berubah banyak. Okay. Itu yang kita belajar dalam beta. You still remember that. Alright. Next one is commodity risk. Okay, commodity you tahu lah, commodity ni can be gold, it can be palm oil, okay, grain, there are many types of commodity, rubber. So what does it mean by commodity risk? This actually risk of loss, the risk arising from the movement of the commodity prices, risk of loss due to changes in the commodity prices. So it occurs when there is a potential for changes in the price of the commodity that is planned to be purchased or sold. So when the price of the commodity rise up, you may not be able to buy at a lower price. When the price of the commodity when the price of the commodity fall, you may not be able to sell at a higher. When the price of the commodity rise up, you may not be able to buy cheaper. So depending on whether you enter as a buyer or enter as a buyer or seller lah, right? Now, volatility risk, it arises when the market value of the position is sensitive to changes in the volatility of any variables. Itu maksud volatility risk. Okay. So volatility risk ini adalah the value of that financial instrument tadi depends on the price fluctuation. Okay, the price fluctuation. Right. Itu maksudnya. The fluctuations in price. Now, trading book of financial institution. Trading book, what is trading book? Before this, we have learned kan trading book tu apa? What is trading book? Masih ingat trading book? What is trading book? Before this, we have trading book and banking book kan? Trading book apa? Banking book apa? What is that? Trading book itu? What is the key difference between trading book and banking book? What is trading book? Anyone? Are you guys still there?
Yes, doctor.
Begitu? Trading book and banking book. Maksud itu. Mana kita belajar trading book, banking book before this? I'm chapter 1 kah? Chapter 2? When we cover best
Chapter 2,
total
doctor.
kan? Chapter 2 kan?
Yes.
Okay, what is that? Trading book, banking book. What's the difference between the two?
Trading book is a short-term asset, can be sold by bank quickly.
Okay,
Banking book is a long-term asset lah, doctor.
Okay, nice. Thank you, Adrian. Okay, so dalam bank punya financial statement ini, as you can see here kan, dalam bank punya financial statement dia akan senaraikan apa dia asset liabilities under trading book. Okay, so as what your friend had mentioned earlier, trading book itu okay, you have to write it down. Those yang mungkin mencari-cari tadi, trading book itu refers to financial instruments where the bank only hold for short-term period saja. Okay, for short-term period. whereby the bank will buy and sell it quickly. Buy, sold it, okay, frequently. What's the purpose? To take advantage over the short-term price movement. To take advantage of the short-term price movement in the market. So unlike banking book tadi, banking book refers to financial instruments that the bank hold for a long term. Okay, the bank hold for long term. Contohnya loan kepada customer lah. Tapi kalau trading book tu dia fokus kepada active trading di dalam market. Active trading. Buy the instrument, sell it quickly. Okay, for that to gain, to take advantage over the short term. Trading book depending on the bank's position lah. Right, depending on the bank's position. What does it mean? So as you can see here, asset in the trading book. Okay, these are the instrument the bank owns. Okay, asset ini maksudnya these are the instrument that the bank owns. Okay, that the bank owns, and the bank entitled to receive revenue from this asset. Okay. For example, dia di sini kita ada equity. Okay, kita ada equity in which the bank hold for trading lah. Okay, equity, stocks, bonds. Okay, dia boleh jadi short term bond kan, government bond ataupun corporate bond. Alright, and then we have derivatives. Kita ada foreign currency, foreign exchange currencies here, which the bank hold for speculation. Okay. Long, maksudnya dia buy position. Dia beli, okay, kemudian dia jual. Beli, jual. Long itu maksudnya long position lah. Itulah maksud dia tadi. Depending on the bank's position. So kalau bank, asset liability, tadi saya mention kan, both asset and liabilities, they can appear in the trading book. Okay, depending on the bank's punya position. You can see here. Depending on the bank's position. Dia boleh jadi bond di asset. Bond di liabilities juga. Dia boleh jadi commodities di asset. Commodities di liabilities juga. Nampak tak tidak? Sini. Nampak kan? Dua-dua ada. So dia appear both asset and liabilities di sini. Depending on the kalau dia appear di asset, depending on the position, what position the bank have. Kalau dia appear di liabilities, what position the bank have. Kalau long, maksudnya dia buy lah. Dia invest. Itulah maksud dia tadi. Ini adalah these are the instrument that the bank own. Okay. And entitled to receive income from this asset lah. So bila dia beli, maksudnya dia invest dalam bond. Long maksudnya investment. Invest dalam commodities, invest dalam foreign exchange, invest dalam stock, invest dalam derivative. Okay. Mortgage backed securities maksudnya dia ada borrower lah. Maksudnya dia lend ini mortgage backed securities. Liabilities is when it issue. Short ini maksudnya sell kan. So kalau bank dia jual bond. Maksudnya bila dia jual bond, maksudnya dia apa tu? Dia also the borrower. Bila dia jual, he is also the borrower. Borrower has to pay interest. Bila dia jual, maksudnya jual sini maksudnya dia issue this instrument. Bila dia issue instrument, the bank is obligated to bayar apa sama customer? Bayar interest income. Okay? Bank kena bayar interest income kepada the bondholder, okay, dan the other investor. Bank issue the security. So bank kena bayar interest income, dividend. Okay, kalau dia issue equities, issue stock, dia kena uh, dia kena bayar dividen lah, kan? Okay. Alright, tengok mana? Sebalas dulu. Okay. Alright, so depending lah. Okay. So bila short itu maksudnya the bank sold the security and it does not own that security. Alright. Boleh boleh paham ini? Boleh. Okay, so depending sebab dua-dua pun kita nampak sana kan. So apa yang ada dia tidak macam corporate punya financial statement, balance sheet dalam corporation. Sebab kalau dalam corporation, kamu tahu kalau dalam balance sheet dia kan, kalau dia tulis aset itu, aset dia comprise of cash, inventory, receivable, prepaid expenses, dia ada apa lagi? Fixed asset. Semua lain daripada yang liabilities. Yang liabilities itu current liabilities dia lah, notes payable lah, lain-lain. Dia ada apa lagi? Dia ada long term liabilities, ada equities, ada itu kalau corporation. But kalau bank, you see that asset kah, liabilities kah, item yang sama. Tetapi apa yang membezakan between asset dan liabilities itu adalah depends on the bank's punya position. Okay, if he buy, maksudnya dia invest. Long maksudnya dia invest. Okay, kalau dia jual, maksudnya dia issue, dia referred as a borrower. So dia they do not own this asset. They do not own this instrument. Okay, itu maksudnya. So ini bukan long term, short term, tiada. Okay, trading book tu tadi kita sudah faham. Itu adalah financial instrument yang financial instrument that is held in a short term period. Okay, short term period compared to banking book. Now, trading risk. Okay, trading risk. Trading exposes banks to risk. Okay, trading exposes to bank risk. Tadi trading book kan? So kita study about the trading risk now. Okay. So trading exposes bank to risk. Late 2006 through mid 2009, housing prices plummeted, affecting mortgage lending industry. In 2007, Bear Stearns hedge funds losses in subprime mortgage market. 2007-2008, bankruptcy of Lehman Brothers, Merrill Lynch, both by BOA, Bank of America. BOA, Bank of America. Okay. And then WAMU here is actually refers to Washington Mutual. Ini adalah US Saving Bank ini sebenarnya. Kita guna reference daripada US kan, so dia guna inilah WA Washington's MU adalah Mutual. Okay, Mutual. So Washington Mutual ini is actually a large US saving bank. Ini sebenarnya adalah saving bank. Saving bank yang terbesar di US. Saving bank, US saving bank. Okay? US saving bank yang terbesar. Di mana it was acquired by JP Morgan Okay, JP Morgan Chase. After dia, ini sebab dia suffered due to, itulah sebab dia suffered mortgage related losses. Mortgage market, ini. Mortgage related losses. Okay. Kalau Merrill ini pula both by Bank of America. Bank of America. Okay. To avoid collapse. Lehman Brothers ini, tahu kan Lehman Brothers, one of the largest failure in the banking history. Ini, Lehman Brothers ini, they went to bankrupt masa 2008. So, kalau kita tengok semua ni contoh-contoh yang dia bagi dengan kita ni, ini events menunjukkan betapa trading risk ini dalam mortgage security, especially dalam mortgage security. Okay. Menyebabkan global financial crisis. Inilah punca sebenar global financial crisis. Okay. So, what's the difference between market risk and credit risk pula? Can be differentiated in terms of 5 factor here. Sources of risk, kalau market risk lah. Okay, which is the changes in market prices itu. Changes in the market prices. But credit risk is referred to default risk by the borrower. Okay, default risk by the borrower. Right, default risk ataupun the failure of the borrower to meet financial obligation. Normally in terms of loan, bonds, itulah. Okay, so kalau yang ini tadi market risk itu is due to changes in market prices lah. That is influence, remember tadi, influence by apa? Interest rate, exchange rate, commodity prices, and the volatility. Volatility is the fluctuations of the interest rate lah. Fluctuations of the variable here, yang interest rate, exchange rate, commodity, semua itulah. Right? In terms of the distribution, mainly symmetrical, perhaps fat tails. Okay? So, apa maksud dia? Okay? Fat tails tadi tahu kan? It is due to extreme events. Mainly symmetrical. Okay? Bila symmetrical, maksudnya dia kepada yang normal distributions tu lah. Normal distribution kan kita kira expected losses due to normal distribution, dan juga kita ambil kira daripada extreme events tadi. Fat tails. Okay? They often show fat tails instead of normal distribution. Credit risk, memang dia skewed to the left lah. Dia punya losses ini dia asymmetric. Okay? Compared ini dia symmetry. Kalau ini skewed to the left, maksudnya dia asymmetric ini. Asymmetric. Symmetric. Okay. Time horizon. So time horizon for market risk normally in short term lah. Okay, because of the daily change in the price, daily change in the prices itu. Credit risk ini normally due to long term, due to loan maturities itulah, following the loan maturity. Kalau market risk ini, itulah kan daily changes in the price. Ini long term, yes, credit risk happen. Dia punya long term ini sebab loan, following the loan maturities, bond punya maturity. Okay, aggregation ini, aggregation, what does it mean by aggregation? Ini di mana business or trading units, whole firm versus counterparty. This is where it combines the individual risk from different asset. Okay, aggregation ini lebih kepada overall risk of the portfolio. Right? So kalau untuk market risk ni dia punya aggregation combines from the business ataupun trading units. Combines the risk of this two form, business and trading units. And then for credit risk, ini refers to the aggregations of that di mana it combine default risk from whole firm ataupun many borrowers lah, maksudnya counterparty ni borrowers maksudnya. Borrowers. Okay, it refers to the default risk of many borrowers ataupun counterparties. Alright. Legal issue. Okay. Market risk, not applicable. Okay. There is a limited legal complexity. Almost not applicable for market risk. Tapi kalau legal issue untuk default risk ini, credit risk, ini ada. Sebab dia melibatkan loan contract, collateral, loan contract, collateral rights, bankruptcy procedure, semua ini. Legal issue sangat penting untuk credit risk. Tapi kalau market risk ni almost not same. Okay. Sebab dia mainly due to, because this one is mainly due to price movement. Okay, price movement in trading. Price movement in traded instrument. Okay. Traded instruments. Tapi kalau dalam credit risk, legal issue is very important because this actually refers to the loan contracts, kan? Very important due to loan contracts, right? Bankruptcy procedure, semua ini berkait rapat dengan legality lah. Bankruptcy procedure. Okay. Boleh? Are you following? Yeah.
Yes, doctor.
Okay. Let's move on to market risk measurement. Now, market risk measurement here important in terms of apa? How do we measure market risk ini? Market risk ini basically it is the process. Before we learn what are the importance of this measurement. First understand market risk measurement ini sebenarnya refer to the process of estimating potential losses. Okay, potential losses in a bank's portfolio. In a bank's losses in a bank or portfolio, in a bank's value or portfolio value. Okay, due to apa? Market risk kan? Due to market due to changes in market lah. Due to changes in market variables. Market variables tu termasuk apa dia? Interest rate, stock prices, semua yang kita senaraikan dalam types of market risk tadi. Exchange rates, semua tu tadi kan? Exchange rates, exchange rates and volatility tadi. Exchange rates, commodity prices lagi, semuanya lah variable dia tu. Commodity prices, sama lagi tadi tu, volatility. Semua itulah market variables itu. Dia adalah process of estimating potential losses lah in a bank's value or portfolio value due to changes in market variables, changes in all of this. Okay. So when we calculate the market risk, basically it provides an amount of losses. How risky is the portfolio? How risky is the portfolio under certain market condition? So importance of market risk measurement. The first one, okay, the reason number one is because of management information, whereby it provides information of how much risk is exposed, how much risk the bank is exposed. Itu maksudnya management. When we measure the market risk itu, they serve as a management information. Okay, management information maksudnya it provides senior management. It provide the management information. Maksudnya it provide the senior management ataupun management of the bank a clear data ataupun information of how much risk the bank is exposed to. How much risk the bank is exposed to. So from this management information maksudnya market risk measurement tu it is important for management information. It is important for management information maksudnya providing the senior management ataupun management of the bank with informations about how much risk the bank is exposed to. So it will help to inform the bank it will help to identify to the bank which type of risk carry the most risk. Okay, so it helps the bank to identify as well which risk factor tadi carry most risk. Okay, carry higher risk lah. Second, market risk measurement is important for setting limits. Maksudnya the bank will use this information, this measurement tadi to set limits. Okay, to set risk limit. Okay, to set risk limit. So dia akan ada value at risk, VAR, limits, stop loss level, semua itu. Right? So bank use measurement, the measurement result daripada you kira-kira, so you dapat outcome dia. So bank will use that outcome, that result from that measurement to set risk limits. Okay, for example here itulah yang stop loss level itu. Third, resource allocation ataupun risk return trade-off. So the measurement, okay, will become a guide decision on where to allocate the capital. Kan? Risk return trade-off. You've learned to calculate this in investment management and portfolio analysis, where when you identify the standard deviation, the risk return trade-off to the portfolio risk, the portfolio return, when you calculate the portfolio risk, so you begin to understand that each of the asset, it carry different risks. So bila dia carry different risks, so you know how to adjust your portfolio, how much you're going to invest in each of these portfolio. Equity, bond, marketable securities, so berapa banyak persen you want to allocate your capital in this market securities, marketable securities, how much percent you're going to allocate your fund for this equity, how much percent you're going to allocate your fund for this bond. So when you understand from this market risk measurement, from that measurement, from the outcome, okay, it becomes a guide decision. Okay, it becomes guide decision where to allocate capital according to the outcome of the market risk measurement. Okay. Fourth, performance evaluation. Okay, performance evaluation. Now, you know that the portfolio manager, they does not only look at the profit, but also the risk. Okay, ada yang indifference about risk, but you need to, the portfolio manager will also look at the risk, because the higher the risk, the higher will be the return, the lower the risk, the lower the return. So the traders ataupun those portfolio managers, they evaluated dia punya portfolio performance, evaluated the portfolio performance, not only based on profit, but also the risk. Okay. So for example, if you invest in an asset that carry higher risk, the performance of that carry higher risk. Contoh, kalau dalam portfolio management tu kan you learn if the asset they are highly correlated, perfectly correlated, dan if the asset is uncorrelated. You know that kan? So the portfolio performance itu kita tidak tengok profit sejak mana aset yang sangat menguntungkan, sanalah kita mau invest. Tidak. Tapi juga melihat kepada risk portfolio performance tu. So bila kita when we learn the measurement of this market risk, okay, it will guide the investor on the portfolio performance evaluation as to whether that asset has high risk ataupun tidak. Right? So kalau dalam portfolio tu, if that the combinations of the asset is perfectly correlated, it will gives higher risk. If the correlations of that asset is uncorrelated, will give chance for the manager, portfolio manager to earn higher return juga. Okay. Alright. Mana? Okay. Now, based on regulation, BIS is Bank for International Settlement. So regulator such as BIS, okay, Bank for International Settlement, ini maksudnya. Bank for International Settlement. Bank for International Settlement. And the US Federal Reserve. US ini sebenarnya US Federal Reserves. Okay. They basically require banks to hold capital, regulate market risk via capital requirement, leading to potential for overpricing of risk. Allowances for use of internal models to calculate capital requirements. So Bank for International Settlement and US Federal Reserves, require bank to hold capital against market risk. They are regulate market risk through capital requirements. So the purpose is that so that to ensure bank can survive during the trading losses without collapsing. Right? Yang capital requirement tu you already know kan, in Basel 1, 2, 3, dia fokus on market risk. Okay? So when it says capital requirements ini, it means that bank must hold certain amount of capital to buffer against the trading losses due to market risk. Now sometimes it says it leads to overpricing of risk. This happen, overpricing of risk ni, dia happen bila if the regulation require holding too much capital. Okay, ini berlaku bila if the regulation require holding too much capital. Okay, again, too much capital, okay, too much capital for certain position. Right. And then the regulators also allow banks to use internal models, internal risk models basically. To use internal risk models. Okay, such as ini allowances for use of internal model, maksudnya the regulation also allow banks to use their own internal risk models. Internal risk model ni contohnya yang VAR and stress testing tu lah. Stress test. Okay, to calculate required capital. Okay. So ini maksudnya. Boleh? Tapi jot down notes tu. Kadang-kadang dia punya statement ini kamu paham dia. Sebab dia taken from the textbook immediately. Okay. Boleh? Any question?
Boleh, Madam.
Dua orang saya tuh, mana yang lain? Tidur? Hah?
Boleh dokter.
Yeah, thank you for the feedback. Jangan kamu limpang-limpang, like I said. Jangan limpang-limpang sambil dengar-dengar. Sambil tulis nota. Alright? Sambil tulis nota. Okay, market risk exposure. So, generally concerned with the estimated potential loss under adverse circumstances. So, this actually refers to apa dia? Refers to potential loss of a bank ataupun portfolio if the market condition move unfavorably, ini maksudnya, under adverse circumstances. So market risk exposure tu maksudnya it refers to potential loss. Okay, potential loss of a bank ataupun a portfolio under adverse circumstances, which means if the market condition move unfavorably. Okay, so this actually generally expressed as an estimate of losses. Okay, as an estimate of losses. So normally kita ada pengiraan macam before this lah, expected losses itu. Ini kita estimate. This is usually yang with a confidence level of 99%. Contoh 95%, where you can, because it says estimated. Okay, estimated potential loss under adverse circumstances, losses that you can estimate, right? From that certain confidence level itulah 99%. Okay. So the focus here is not just an average outcome, but also on the worst case scenario, yang 99% begitu kan, worst case scenario. Now, what are the approaches to measure market risk exposure? What are the approaches to measure market risk exposure? So the first one is JPM. JPM ini sebenarnya adalah JP Morgan. Okay. JP Morgan. Okay. JP Morgan risk matrix. Following the variance covariance, ini kamu tahu kan, variance covariance. They are basically developed by JP Morgan, right? In which this risk matrix ini dia assume asset returns are normally distributed. Please write it down. Assume asset returns normally distributed. Okay, normally distributed. Historical simulation. Okay, the word itself, historical back simulation. Historical simulation. Ini maksudnya historical simulation. So ini uses actual historical data, uses actual historic market data. Okay. This actually uses historical market data. Okay. Historical market data. For this, For this approach, there is no assumption about return distribution. Kalau tadi, assume apa tadi yang tu? Normal distribution kan? Asset returns are normally distributed. Tapi kalau historic or back simulation ini dia does not have assumption about asset return, okay, distribution, and it uses historical market data to simulate, okay, what portfolio losses would have been. Okay. So kalau yang the first one tadi tu JPM risk matrix, dia punya simulation adalah based on asset returns normally distributed. Kalau normally distributed tu, you can still remember tadi, it does not capture itu fat tails kan, atau real world shocks itu. But with this historical simulation, it capture fat tails, extreme event, okay, ataupun real world shocks, okay, financial shocks. Monte Carlo simulation. This one is based on statistical model. Monte Carlo ni dia based on statistical model. And compared to the other two earlier, this one simulation is very powerful because it analyzed different distribution, not just normal distribution. Okay. Kalau historical tu dia guna historical market data. Nah, yang ini dia very powerful because it allows the model, the risk model itu, modeling of different distribution. Okay. Expected shortfall. Expected shortfall ni dia looks, this one is looking beyond VAR. Okay. Maksudnya beyond VAR tu, if 95% confidence level, so dia akan tengok yang what about the 5%? What is the average loss of that 5%? So dia provide more information about the severity, provides more information about what? About the severity of tail risk. Okay, itu expected shortfall. Basically, it look beyond the VAR. Okay, beyond VAR maksudnya beyond 95%, beyond the confidence level, beyond the expected loss, right? Now, if you look at this risk metric model, kan tadi kita ada beberapa approach, ada 4 approach di sini. 3 major approaches of measurement. So 3 major itu adalah inilah. 3 major, 1, 2, 3. Okay. Kita ada JPM, risk matrix, historic or back simulation, and Monte Carlo simulation. So expected shortfall is just the explanations of what does it means by this in relations to the market risk exposure. Now, risk metric model. Okay. Now, The idea is to determine the daily earning at risk. So you notice here, daily earning at risk, D, E, A, R. Itu maksudnya. Okay. Is to determine apa dia? The daily earning at risk, which is equivalent to dollar value of the position, darab price sensitivity, darab potential adverse move in yield. So maksud di sini ini adalah price volatility. This represent the price volatility lah. Volatility. So dollar market value of the position, there are price volatility, in which price volatility itu refers to price sensitivity of the position darab dengan adverse potential adverse move in yield. Okay, ini dia punya formula. What is DIA? DIA is the daily earnings at risk. So if you are given this, risk metric model, kalau maksud dia determine the daily earning at risk. Daily earning at risk. So this is basically to estimate how much the portfolio could lose in one day. Itu maksud dia. If the market price move unfavorably. Apa tadi? To estimate how much a portfolio could lose in one day. Okay, itulah tu dia. Yeah. If market moves and if market prices move unfavorably. Okay, how much a portfolio could lose in one day? Sebab dia bilang daily, kan? Daily earnings at risk if market prices move unfavorably. So dollar market value of position ni menunjuk kepada size of the investment lah. Size of the investment ini adalah size of the investment. Contohnya 10 million dalam bond portfolio. 10 million dollar bond portfolio. Itu size of the investment. Price volatility, this can be explained by the multiplication of the price sensitivity and potential adverse. So what is price sensitivity? Okay, price sensitivity ni maksud dia ini price sensitivity merujuk kepada how much the price change when the interest rate change. How much price change when interest rate to change. When interest rate change. Okay, when yield change, how much price change lah. Ini yang kita belajar when we calculate duration before this. Bond duration. Last time kan, price volatility. Potential adverse move in yield. Okay, ini adalah worst case lah. Movement in yield. Potential adverse move in yield ni, ini adalah volatility in yield lah. Okay. So let's check here. Tengok. For fixed income, okay. For fixed income, risk metric model for fixed income security, maksudnya for bond. Okay, ini maksudnya for bond. If you look there, dia is the daily earning at risk kan. So market value of position, right? Market value of the position darab dengan price volatility. Okay. So price volatility ini, you tahu lah kalau price volatility ini dia comes from the interest rate changes lah. And this can be estimated using modified duration. So how do you calculate modified duration itu? Daily price volatility equal to modified duration darab dengan potential adverse daily yield move, where MD equal to D. D is the duration. D is the Macaulay duration. Still remember Macaulay duration? Okay. Macaulay duration. So R is the yield to maturity lah. YTM. Okay. This is what we learned before. So how do you calculate price volatility? Guna formula ini. MD darab dengan potential daily adverse daily yield move, which is D divided by for MD equal to D divided by 1 plus R. Okay. Ini formula. And so if market value of the position, maksudnya ada market value of a bond. Okay, market value of a bond. So market value of the bond equal to face value divided by 1 plus R to the power of N. Okay. So where face value tu you tahu lah, dia adalah kalau bond dia adalah par value 1,000. R is the yield to maturity. Ini adalah YTM. N is the years to maturity. Okay. And then to find the end day market value at risk. End day VAR equal to dia darab dengan punca kuasa N. So what does it mean here? For example, end day ini mungkin untuk 10 days value at risk. 10 day market value at risk. Okay, kalau dia bagi you specific berapa hari. Alright, sebab ini daily. Kalau daily dia kan. So ini kalau on the 10 days market value at risk, so 10 day VAR equal to dia, you kira dia tadi, darab dengan punca kuasa 2N. N itu adalah 10. Yang 10. N itu adalah 10. Okay. Punca kuasa 2 dia. Right. Let's look at this example 1 dulu. Baru kita faham aplikasi calculation-nya. So, kalau kita ada financial institution has a $1 million market value. Right? Market value position in zero coupon bond. Zero coupon bond, coupon bonds of 7 years to maturity with face value of 1,600,000. Yield of this bond is 7.2. Yield of this bond is 7.2 for 3 per year and standard deviations of 23. Okay. 23.3 points. Calculate modified duration. Calculate modified duration. MD tadi. Calculate price volatility. Calculate daily earnings at risk. Okay. EAR tu maksudnya inilah singkatan dia, earning at risk itu. 5-day bar. Yang 5-day bar itu semua di sini. 5-day bar, so masuk sini. Tapi before that, you kena kira dulu dia lah. Okay, kena kira dia. So, ni di atas ni. And then before that, okay, kena kira lagi price volatility. So, how do you calculate price volatility? Ini, price volatility, daily price volatility based on the MD. Modified duration, darab dengan ini, potential adverse daily yield move. Modified duration, ini, working number 1, D divided Macaulay duration, divided by 1 plus R. Okay. And then, so, before that, kena kira lah, modified duration. Modified duration. Ni modified duration pun kena kira dulu. Baru darab dengan potential adverse daily. Price volatility itu adalah hasil darab ni dua lah. You cannot calculate price volatility without the modified duration. That's why it asks you calculate modified duration dulu. Darab dengan potential adverse, dapatlah daily price volatility. So how do we calculate this? Okay, how do we calculate this? Macam mana kira? So kita extract dulu information. Apa yang ada? F1 financial FI financial institution has 1 million market value position in zero coupon bond of 7 years. Okay. With face value 1.6 million. Yield of this bond, yield to maturity is 7.243. So, pertama sekali kita kena kira modified duration. So, 1 Roman, ni example 1. So, pertama sekali kita kena cari D mode, modified duration. D mode atau modified duration. Tulis kemas-kemas. So, D mode itu tadi adalah apa formula dia tadi tu? Ini nah, MD kan? D, okay, 1 plus R. D adalah Macaulay duration tu lah. Okay, so dalam soalan ini dia sudah bagi berapa? 7 years. 1 million market value position in zero coupon bond of 7 years to maturity. So ini adalah Macaulay duration. So 7 divided by 1 plus R. 1 plus R. R is the yield to maturity, kan? So 7.243%. So ini convert dulu loh. So ini dia jadi 7 divided by 1 titik kosong titik 07243. So, bila you bagi dapat berapa nih? How much ya?
6.527.
6.527. Okay, 6.527. So modified duration ini dia cater for price sensitivity. Macaulay duration dia tidak sedetail modified duration. Modified duration it caters for price sensitivity. Okay, itulah dia ada price volatility tadi ya. So instead of 7 years duration, okay, it modified to 6.53. So baca balik keeping investment management and portfolio. Right? What does it means by Macaulay duration? Now price volatility. Okay. Price volatility, how do you calculate for the price volatility? Ini setelah ini in years nih. Okay. Yes. 6.527 ataupun 6.53 years. So second, okay, price volatility. Now price volatility here, price volatility is equal to price volatility. MD equal to yield move. Price volatility is the price sensitivity of position darab dengan potential adverse move in the yield. So potential adverse move in the yield 23.3. Tadi soalan bagi standard deviations of 23.3 points by 100. Mana? do we calculate the price volatility here? The price of volatility here, it is given that yield on these bonds, yield on these bonds is 7.243. That is YTM per year. And the standard deviations of 23.3 points. In decimal is how much is this? In decimal is how much? Kalau price volatility di sini price volatility equal to price sensitivity of position darab potential adverse in yield. So price sensitivity ini adalah refers to your modified duration. So modified duration we already calculate darab dengan potential adverse daily yield move. So potential adverse daily yield move ini adalah dia punya formula ini. Dia a bit of complicated actually. So ini dia pakai Z-score. Z-score 1.65. I'm just gonna write it down here. Kita faham selepas ini. Okay. Dia guna Z-score. So potential. Right. So ini untuk kira price volatility. So price volatility assume 1 day. 1 day ini 95%. Okay. So potential adverse move in yield ini changes in yield. Ini changes in yield. Move in yield, changes in yield at 95 ini dia guna formula Z, standard deviations of Y, standard deviations of the yield. So standard deviations of the yield tu yang 23.3 lah. So here Z score dia untuk 95 ini adalah 1.65 darab dengan standard deviation in standard deviations of 23.3 points. Ini adalah 0.00233. This one is in what is given is in basis point. So in decimal dia bahagi dengan, kalau kira betul ini 10.000 nih, bagi 10.000 dapat 0.0233. 23.3 kalau bahagi dengan 100 is 0.233. Tapi jawapan yang saya ada ini 0.00233. Okay. Yang ini datang daripada mana? Datang daripada 23.3 itu. Yang standard deviation divided by 10.000. Baru boleh dapat nih. We need to check first why 10,000. So kenapa 1.65? Because The Z-score untuk one day 95% is 1.65. So bila kita kira price volatility ya, guna formula ini MD darab potential adverse itu, yang atas ni jawapan dia adalah 0.003 0.0038445. Okay, so the price volatility equal to, okay, D mod tadi kan changes in yield. Okay, changes in yield. So 6.53 darab dengan 0.0384445. So ini jawapan dia adalah 2.509. 0.0. You try to calculate it also in case that this answer is incorrect. Ini apa yang saya dapat? 38445 darab dengan 6.53. Okay. So darab dengan ini dalam peratus. So, kena convert di dalam peratus itu. Ini sebenarnya adalah 0.2510. 25104. So darab dengan 100. Macam tidak kena ni. 6.53. Kosong poin 003 darab dengan ini 0.025 0.0251005 darab dengan 100. 2.51. Okay. So ini jawapan dia 2.51. 2.51%. Okay. Let me just share first the Z-score yang shared by the RP. Ini based on the RP ya. RP dia share this. So I'll share it with you guys. Ini sebenarnya ada missing info by the RP. Let me just forward it you guys. Look at that Z multiplier. This is actually shared by the RP, resource person. Sebenarnya ada kurang info nih. Ada kurang info deh. Dan ada missing info. Sebab standard deviations itu sebenarnya perlu dicari. Tetapi di sini dia terus bagi yang 23.3 points itu. 23.3 points. Standard deviations of 23.3 points. Okay. And then dari mana dapat ini Z-score 1.65 ini sepatutnya this supposed to be given. This one supposed to be given. Ini sepatutnya yang missing di sini dalam soalan. Okay. Ini dalam soalan it missing here. Because how would you know 95 kah, 90 kah, 99 kah? How would you know that? Tapi mungkin you can use this formula lah, Z-score multiply with standard deviations of Y. So the standard deviations of 23.3 ini pun saya akan nak check balik dengan RP because it seems that if we want to change this into decimal place, ini adalah basis point. When we want to change to decimal points, we normally divide it by 100. Tapi dia punya jawapan di sini berlobik pula. 0.0023, macam ibarat bahagi dengan 10,000. But I'll just share the answer here. Saya pun cuba untuk memahami. But ternyata memang RP ada mention, ada kurang info lah. Okay, kurang info dia. But nevertheless, this is the way. Okay, starting from D mode, price volatility. Okay, price volatility here. Okay, and then calculate price volatility D mode daripada change in yield. Ini mungkin I need to check yang investment management and portfolio sebab mungkin ada persamaan di sini. Change in price yield here. Okay. Daily earnings at risk. Are you guys following? Tidur ke? Following?
Madam, yes.
Yes, madam.
Yes.
Yes, madam.
Jangan kamu nanti satu orang yang syok sendiri di sini mencari-cari jawapan, kamu orang dur sana. Okay? So, yeah, 2.33. 99% is 2.33. Yeah. 99%, 2.33. Saya tidak berapa faham juga yang soalan ini bila dia ada missing info, the automatic the rest of the others punya formula itu pun kita guna hati-hati. So next one is the daily earning at risk. So daily earning at risk itu you tahu lah, daily earning itu how do you calculate the daily earning at risk? Balik lagi sini. The endeavor. So you have to calculate first the dia here, daily earning at risk. Okay, multiply with the n. Alright. And finally, 5-day, okay, ini adalah yang 5-day, ini adalah yang 5-day variance lah. Tapi before that, kena kira dia. Dia is the market value of the position. So, market value darab dengan price volatility. Price volatility kita sudah kira 2.51. Market value dia adalah 1 million. So, 1 million multiply 2.51%. So, dapat itu, kira lah punca kuasa. Cuba kira dulu ini. Right? Ini dia. The next one, let's say all informations are complete for us. So, now we calculate dia. Dia, okay, tadi is the market value darab dengan price volatility. So, price volatility kita sudah dapat. Market value adalah 1 million. 1 million market value. RM 1 million. Darab 2.51%. How much is this? Berapa ini? How much is this?
$25,100.
25,000.
100.
Ini dalam. Okay. So 25,100 darab dengan apa dia itu? Punca kuasa 5. So berapa nih? Punca kuasa 5. Berapa itu? Sini berapa? Berapa? Punca kuasa 5 darab dengan 25,100. How much is this?
56,125.331.
3?
1.
56,125.31. Yan lang. 5-day variance, 5-day value at risk. Untuk 5 days punya value at risk, 56,000. Daily would be 25,000. Daily earning at risk. So untuk 5 days, 56 lah. Okay. So with 95% confidence tadi, apa maksudnya ini? Maksudnya, sebab kita guna tadi 95% tu. Sini atas Tadi kita guna 95% tu kan. So what does it tells you here, this one? With 95% confidence, okay, the position is expected to lose, okay, the position is expected not to lose more than 25,000 a day, okay, or 56,125.31 over 5 days under the model's assumption, which is normality lah. Okay, normality distribution. Inilah maksud dia. Right? Let's try to calculate this one. Follow Bank has 1 million position of 5-year 0 coupon bond with a face value of 1.4 million, 2,552. The bond is trading at yield to maturity of 7% and standard deviations of 12 basis points. Calculate satu D-mode ataupun modified duration, price volatility of the bond, the daily earnings at risk. Okay, which is D. Coba you kira dulu ni. Try to calculate first. What is the answer for this? doesn't provide the solution for 1, 2, and 3. Video provide solution to 4. And 4. Tengok dia punya. Dia tidak bagi jawapan. Okay, try first. Itu. Okay, 4 o'clock sudah. Tidak sedar masa. Are you guys following kah?
Yes, Doctor.
Yes, madam.
Doctor.
Ada mencabar sikit lah untuk faham yang Z-score itu sebab dia tidak bagi. Nevertheless, saya cek dulu dengan Arpil. Yang especially the standard deviations itu macam mana dia boleh dapat 0.0 berapa tadi itu kan? 0.0. Yes, Pak. Nih, macam mana dia boleh convert ini dia jadi hanya dia convert 23.3 ini kepada decimal places 0.00 and apa reason kenapa convert begini jauh. Dan how do we understand yang begini? And by in that question, adakah ini will be given atau purposely tidak diberi, suruh hafal? Kan? So I think some of the info is missing juga. So we will continue example 2 in our Wednesday class. Kita kasih habis ini example next Wednesday. Boleh?
Boleh, madam.
Boleh, Dokter.
Boleh, doktor.
Okay lah. Please don't forget to sign your attendance at your future. I think that's all for today lah. We managed